Hi, I'm Matt Rosenberg with RoseCap Investment Advisors. I wanted to make this video because I've been getting a lot of questions lately about whether it's a good time to get invested or not. And probably because markets are at all-time highs and people are worried of a downturn, which I totally understand given that the possibility of a downturn is constantly pushed in our face.
Markets have been overvalued and the stock prices have been too high, especially in the United States over the last couple of years.
Market-based measures of inflation compensation have moved up a bit.
You have to wonder, this isn't a bubble, but what would a bubble actually look like?
So I created this video to give you some information about whether now is a good time to get invested or you should wait with that excess cash. First, I'm going to show you why it's probably in your best interest to put that money to work right now rather than wait, even though it can be tempting to hold out for something better. Then I'm going to support that with some research and statistics to show why it's in your best interest. And then finally, I'm going to show you some tips about a responsible portfolio that'll hopefully keep you from having to worry about market ups and downs so much. Okay, so you're sitting on some excess cash that you want to invest. Wouldn't it be great to put all that money into the market right as it's at a bottom? Or maybe you're not even saying that. Maybe you're just saying, I don't want to put my money into the market and then watch it go down by 10 or 20% the day after I invest. I totally understand that dilemma with investing. In fact, it reminds me of a problem I face 3 times a week right here in this parking lot. 3 days a week, I teach a finance course right here at this university. My goal is basically to get parked and then get into the building as fast as I can. Unfortunately, at that time of day, parking spots can be a little bit hard to come by. Here's what this looks like. I can almost always find a spot right away near the back of the lot as soon as I pull in. If I just park there and walk in, I know I'll make it into class on time. But it's also a longer walk into the building. So I do what most people do, which is drive right up to the front and start going up and down the aisles looking for a spot. So in this example, getting parked is just like getting invested. There's a chance that you'll find a spot right up at the front, just like there's a chance you could put all your money into the market right at the bottom, but it's just not likely. It'd be much better to just get parked and get in the building, or you could say put all your money into the market and get invested responsibly, and that'll give you a much better chance of achieving your goal. And I just heard a spot, like we should go get that, man, like get the... On it. There's 2 types of assets. There's a consumption asset and a productive asset. Consumption assets are things that lose value over time, like a TV or a car or clothes. Deferring the purchase of a consumption asset is actually a good thing. Like maybe during the holidays you go into a store and you want to buy a TV and you're like, well, I'm going to wait a little bit because this might go on sale. That's a good decision because you're just delaying the inevitable, which is that asset's decline to 0 value. Productive assets are different though, like machinery or equipment or a stock. So when you delay a productive asset purchase, you're actually delaying the receipt of that cash flow that the asset produces. And that actually lowers your chance of having more money in the future. Let's say that you have some cash you want to invest, and when you do invest, you're going to want a moderate risk allocation. Here's what this looks like. The red and orange slices of pie here are stocks. The blue and purple represent bonds. The return expectations of this portfolio include portfolio income or yield of about 2.4%, an expected annual return of 5.5%, and about 6% risk, or standard deviation around that expected return. When you decide to finally pull the trigger and invest, that's what your portfolio will look like. Now, you decide to wait instead, and that's been a painful process, especially if you've been doing this for the last few years because the markets have done nothing but go up. But let's not worry about that, let's just think about the future. If we run a simulation with 50,000 iterations on a portfolio of these parameters, you have about a 32% chance of success by waiting 1 quarter and the market actually going down in your favor. Now that's not bad, 32% chance of success, but that's also not good. That's a 68% chance of failure. It's not exactly the odds I want with my investment portfolio. And the odds only get worse the longer I wait too. Here's a chart that shows the probabilities of waiting different time periods and your probability of being successful or having it pay off for you by waiting. As you can see, you have a slightly better chance of winning by waiting if you plan to invest more aggressively, but still not much, and the longer you wait, the worse the odds get for you. For example, if you sit out of a moderate risk tolerance for 5 years, you only have a 2.7% chance of that paying off for you. Here's a graph that shows the declining probabilities of waiting across the 3 risk levels. Most people don't intend to sit out for years either, but as anyone with kids know, time flies. Also, they're continually influenced by new information. For example, the market goes up. Now you just want to wait longer. This is a pretty difficult and stressful game to play with your investments. So the reason that this might seem alarming to people is that when they invest, they tend to think that they're investing entirely in the US stock market. But with a responsible portfolio, that really shouldn't be the case. You should have multiple asset classes, which include US stocks, international stocks, bonds, currencies, commodities, and whether you're in a risky or a safe portfolio, you should have at least some percentage of all of those. Now, you guys, there's a parking spot right up front right there. So a responsible portfolio should have at least some percentage of each of those asset classes in it, even if it's a very aggressive portfolio or if it's a very safe portfolio. The same concept applies to people who are currently invested in the market. Trying to time a market downturn by selling all of your investments to cash is pretty ridiculous. That would be like me being in the building already, looking out the window and seeing an open parking spot in the front row, and then trying to run downstairs to get it. By the time I got downstairs, somebody would probably have already taken it. The odds just aren't going to be in my favor. This chart shows the importance of staying invested once you are invested and not trying to time the market by going in and out. The first bar on the left shows the returns of an investor in the S&P 500 over the last 20 years. $10,000 invested the entire time would have grown to over $48,000 over an 8% annual return. However, if you missed only the 10 highest returning days of that time period, your investment would have only grown to $24,000, or less than half of what it should have. Those top 10 days represent only 0.1% of all the trading days over the last 20 years too. So essentially, if you're trying to time the market to get the top days and miss the bad ones, you have about 0.1% chance of being successful. Good luck with that. If I'm going to do something that's gambling with my money, I at least want to be having fun while I'm doing it, like playing blackjack or fantasy football or something like that. The last thing I want to show you is a Dalbar study, which shows the average returns to asset classes over the last 20 years versus the returns that investors actually got in their portfolios over the same time period. This chart shows the returns of each of these asset classes: real estate, stocks, bonds, gold, oil, even balanced portfolios, and they're all higher than the average returns of the investors in these asset classes, as you can see by the orange bar on the right. How is this even possible that the investors are earning less than every single one of the asset classes that they're investing in? Well, that's because people do irrational things like wait to invest, go in and out of the market with their investments, rather than just get invested, stay invested, and hold responsible portfolios. Having a responsible portfolio is key, but there's a lot more to that than just diversifying, maybe the topic of a future video. But for a first step, you should seek out the help of a financial advisor. And by advisor, I don't mean somebody who's going to sell you commission product like a life insurance agent or a broker. I mean somebody who's a true advisor with the education to know what they're talking about and the fiduciary obligation to act in your best interest, like RoseCap Investment Advisors. Have a great day.